Hello everyone, I am Dr. A. Nagalakshmi, Assistant Professor, Department of Commerce with Finance in Dr. SNS Rajalakshmi College of Arts and Science, Autonomous, Coimbatore. I am here to explain a beautiful and interesting topic, valuation of goodwill and valuation of shares in the course Corporate Accounting. Now we shall go for the introduction of valuation of goodwill and valuation of shares. So, in business combinations where mergers, acquisitions, partnerships, and corporate reconstructing occurs, valuation plays a key role. So, for all these said items happens in a company, valuation is a very important key which play a role in that aspects, that is role in that business combinations. We can see the two important aspects. So if a merger happens, an acquisition happens, if it is a partnership or a corporate restructuring, that is every company, it's mandatory to have valuation of goodwill and valuation of shares. We can see what is meant by valuation of goodwill. Goodwill represents the reputation. Goodwill means we know that it's a brand name, it has a value. So goodwill represents the reputation, brand value, customer loyalty, and earning capacity of a business beyond its tangible assets. That is said to be valuation of goodwill. We can see valuation of shares. Valuation of shares refers to determining the fair value of a company's equity shares, especially in case of issue, buyback and amalgamation or sale of business. So here the shares are to be valued for determining the fair value of company's equity shares. See in what cases? In case of new issue, buyback of shares, while making the amalgamation, or the time of sale of business. Now we shall go in depth to this concept. Now we are going to see valuation of goodwill. First we can see a general meaning of goodwill. Goodwill is the intangible assets where we can feel, we cannot see. Where we can feel. See, for example, Tata Groups is there. We will say, oh, very big company. It's a very genuine company. Likewise, Reliance Groups, Geo Groups. So, we have a value. We know the value of that brand. We cannot see what is goodwill. It will be in this shape or at that shape. It will be big or small, nothing. You can feel the goodwill. So goodwill is the intangible value of a business arising from the factors like reputation, customer satisfaction, brand loyalty, skilled employees, and favorable business location. It represents the earning potential of a business beyond the normal return on the tangible assets. That is, the company will earn abnormal profit than the expected normal profit. That is said to be, that company is said to have a best goodwill. Need for valuation. So, what need makes the valuation of goodwill? Admission of a new partner in case of partnership, retirement or death of a partner, amalgamation of companies, sale of business. Next one is conversion of partnership into company. In these cases, the goodwill has to be valued. Admission of a new partner. When new partner enters, new partner will compensate old partners for reputation built. Likewise, retirement or death of a partner. Retiring partner or deceased partner is to be compensated for their share of goodwill. Amalgamation. Goodwill is valued to determine the purchase consideration. Sale of a business, to find the selling price above tangible assets. Conversion. Goodwill is transferred to the new entity. For example, Tata Groups is taking, for example, I am running a partnership. Now I am going to convert into a company, means my partnership firm already has a good name. So it can be transferred to a new entity from partnership to company. See, there are various methods to value the goodwill. Commonly used method is average profit method, super profit method, capitalization method, annuity method. We can see what is average profit method. Average profit method is a common method of valuation. Here the goodwill is valued as average profits into number of years purchase. So an example is given for that. Average profit is 2 lakh. Years purchase is 3. So the goodwill will be 2 lakhs into 3. Average profit into number of years purchase. Super profit method. Super profit is equal to actual average profit minus normal profit. Actual average profit. This is the it is the formula to calculate super profit. Actual profit minus normal profit. Now we are going to see goodwill. Super profit into number of years purchase. So normal profit is equal to capital employed into normal rate of return divided by 100. So first we have to calculate the normal profit, and then we have to calculate the super profit, and at last we have to calculate the goodwill. Capitalization method. So capitalization of average profits. Goodwill is equal to capitalized value of average profits minus net tangible assets. Capitalization of super profit. The formula to calculate goodwill is super profit into 100 divided by normal rate of return. The last method to value the goodwill is annuity method. Goodwill is equal to present value of annuity of super profit for a certain period discounted at normal rate of return. So these are the 4 methods for valuing the goodwill. Now we shall see the general concept about valuation of shares. We know what does mean by valuation of shares. Determining the fair value of the equity shares. Valuation of shares means determining the fair price of a share of a company. It depends upon company's performance, assets, liabilities, earning capacity and market condition. So keeping these as a factor, we can determine the fair price of a share of a company. So company's performance, assets, liabilities, earning capacity, market conditions. Need for share valuation. Why share is to be valued? Share valuation is essentially in following cases. What cases? Purchase or sale of shares of an unlisted company where market price is not available. Amalgamation, merger or takeover of companies happens. Conversion of shares into stocks or vice versa. That is conversion of stocks into shares. At the time of this occasion, valuation of shares is mandatory. Taxation purpose. So wealth tax, gift tax, estate duty, etc. Issue of fresh shares, rights or buyback of shares. When these happens, valuation of shares has to be done. Settlement of disputes among shareholders. So these are the reasons initiate for share valuation. Now we can see the methods of valuation of shares, as there are methods for valuation of goodwill also. Here there are some methods, that is net asset value method, NAV method. Here the formula is value per share is equal to total assets minus liabilities divided by number of equity shares. This method is suitable for investment companies and liquidation cases. This is a normal method, NAV method. Now we can see to the yield method. So yield method, we have earning yield method, dividend yield method, based on profits and based on dividends. So yield, earnings yield method based on profit, dividend yield method based on dividends. We can see the formula for the earnings yield method. Value per share is equal to maintainable profit into 100 divided by normal rate of return. Here divided by number of shares. Likewise, dividend yield method, value per share is equal to dividend per share into 100 divided by normal rate of return. The third method is fair value method, combines NAV and yield method. So the combination of NAV method and the yield method is said to be fair value method. Fair value per share is equal to net asset value per share plus yield value per share divided by 2. The next method is market value method. Market value is based on actual quoted market price of share in the stock exchange, applicable only to a listed company. The last method is discounted cash flow method. Value is calculated based on the present value of the expected future cash flow, discounted at an appropriate cost of capital. So these are the methods of valuation of shares. I hope you understand the necessity for the valuation of shares and valuation of goodwill happens, and the methods of calculating those things. Thank you for the patience listening.